Hello, everyone, and thank you for spending some of your morning or lunchtime with us for our first strategy update of 2025. You realize it will be Christmas again before we know it, but that's for another day. Anyway, my name is Keith Duran. I'm the Senior Vice President of Business Development, and we're joined as always by Jim Warner, Managing Director, Head of Research, and Co-Portfolio Manager. I think most of you have been on these calls before, but for those that are new, I'd like to take this opportunity to let you know that this is more than just an economic commentary. Rather, it is not only designed to provide some insights into the economy and markets, and given that our research and intelligence gathering is done in-house, our perspectives are sometimes unique, but also we do these updates to tie what is happening in the world and the markets and economy back to what's in your portfolio. And because we manage a portfolio of high conviction securities at a maximum of 30 positions, it's very easy for clients to understand what they own and why they own these positions. So before I hand the stage over to Jim, I'd like to encourage you to ask questions throughout the presentation by clicking on the Q&A link at the bottom of the screen, and then we'll address those at the end of Jim's prepared remarks. So without further delay, Jim?
Great. Thank you, Keith, and thank you to everyone that is joining us live. Let me share my screen here as I always do. And Happy New Year. Yeah, it's great to be back talking to you in the calendar 2025. And I think the question really is do we have another great year ahead? So I want to take some time today to review a little bit about what happened during 2024, talk about where we sit as we move into 2025, and then how, as Keith just enumerated, how we think about that playing into our portfolios. So as we go into, if we take a quick look back at 2024, and actually what we're really doing here on this page is we're stepping back and we're looking at 2022, 2023, and 2024 for the S&P, NASDAQ, Dow, the equal-weighted S&P, and the FTSE All-World, just for some perspective. Because we've just had two really great years in a row, but it's also important to forget, not to forget, that 2022 was a really terrible year. And so in 2022, we had basically surging inflation, the surging interest rates, a lot of confusion as to where the economy was going, and we had a correction from the kind of post-COVID recovery trade that the markets had experienced. As we moved into 2023, that bounce back trade worked great. You can see that the more you were down in, say, the NASDAQ, the higher the bounce back in 2023. But really, what characterized 2023 was what I'll call better than feared. There was sort of this prospect of inflation that hung over the market, this cloud, and yet things were not as bad as we expected, and that companies were actually learning how to digest higher interest rates, and essentially the worst fears weren't realized. And so as we went into 2024, I think what really made that different, and I'll actually quote Keith, who said this on a internal call the other day, is that it was better than expected. So more optimistic about the economy, and the economy kept coming in better. Meanwhile, inflation kept coming down, and doing all of this in the face of still elevated interest rates. And so, we've gone from a position of fear into a position of better than expected. And so we're really kind of moving into 2025 with, I think, a baseline of optimism that maybe is even higher than where we were a year ago. Now, you can also see from this chart just how incredibly different the returns have been between, say, the S&P 500, which returned 25% this past year, versus the S&P equal weight, which minimizes the impact of the Magnificent Seven, and came in at 13%. So if you owned the S&P 500, you actually had this disproportionate allocation to the Magnificent Seven, which was terrific last year, great the year before, and awful the year before that. So going into 2025, we don't see that storyline really changing. You know, when people ask me, what do you think the market is going to do? You almost have to disaggregate it into these two buckets, the Mag 7 and the rest of the market. And I'm going to go into this in a little bit more detail here in another slide. If we look at the fixed income performance during 2024, it was pretty muted. In fact, it was terrible if you stayed way out the end of the curve. The aggregate bond index, which is the columns on the left, you can see after a terrible 2022, had a little bounce back in 2023. And then this year was really pretty muted, only a 1.3% return. You can see that across investment grade corporates, where what surprised to the upside was where people were taking credit risk. So high yield, leverage loans, more credit risk, those performed better. That tends to happen when you have a positive beats on the economic front. Now going into 2025, we're much more sanguine on those parts of the fixed income market, only because spreads have gotten to incredibly tight places. And then if you can see even far out the curve, when you're adding a lot of duration, the 20+ year Treasury bond ETF, this is where you've seen massive losses as interest rates have generally been rising. And, you know, I think that the jury is still out as to where the long end of this curve is going to settle out. It could be around here. It could be 5. It could be 5%. It could be 5.5. You know, it's more data is required in order to really, you know, zone in on what the right range is for the long end of the curve. And then to touch on commodities, you know, commodities is a big part of our portfolios, and gold was a massive contributor to performance last year. It was up almost 27%. It beat the S&P 500. And so that was a pretty important part of certainly generating returns in our portfolios. Oil, natural gas, really pretty muted, very kind of volatile, but didn't really return much. And we have pretty limited exposure, as well as limited exposure to copper, which is really being tied up over the debate on whether China is going to stimulate their economy enough, because copper tends to be highly correlated to the Chinese economy. So, you know, but we're delighted in the way gold has performed. I didn't put uranium on here only because the spot price for uranium is a little squirrely, but that's another commodity that we love at this time. So getting back to the Magnificent Seven, which drove performance in 2022, did it again in 2023, and in 2024 drove 73% of the S&P's 25% return. That's the big takeaway. So, you know, now obviously you can't really construct a portfolio that's 100% Mag 7. Obviously, we have a lot of Mag 7 in our portfolios, but it just shows you just how concentrated the returns were. And of course, the big story of the year was NVIDIA, particularly during the first half, as all of the AI themes that we've been talking about for years now really came to pass. And, you know, NVIDIA put up almost a little over 170% return, considering that it's about 6 or 7% of the index itself. It generated 39% of the total return of the S&P. So, you know, there are a lot of people out there that have a lot of NVIDIA in their portfolios right now. It's a really important thing for us to, you know, monitor and watch that very carefully, because you can see how, you know, it goes down 20%, it'll drag down the whole index and a lot of portfolios with it. So very important to understand the concentration risk that exists in a lot of portfolios. And, you know, if you're managing portfolios for your own clients, it's important that you take a look at that too. Now, the other thing that 2024 represented was a real resetting in rate expectations. So a year ago, you've seen a variation of this chart before in previous presentations, but basically, if you look at the Fed futures and where they're priced based on the next, you know, the next Fed meeting or the Fed meeting that say on that was scheduled for March 20th of last year, the gray bar is where the Fed futures expected them to be as of the end of 2023, so looking into 2024, and the actual is in the blue bar, so where it came out, and so and where it is today. And what you can see is that expectations were way too aggressive for rate cuts going into last year. The expectation was for a little over 6 25 basis point cuts. We got 4, and we didn't get rate cuts until September. The market was expecting March. So for a lot of last year, the bond market in particular was dealing with having to constantly uh, fight this headwind of higher interest rates. Now, it wasn't nearly the headwind that we've experienced in the last few years, like in 23, but we still experienced it this year, and that's why you had a very muted performance for bonds overall. And the other thing I'd point out, and we've mentioned this a couple times in previous webinars, is that the Fed put his back. So, the one thing we know is that looking at Fed futures is basically going to give you the wrong answer because it never seems to be right. But the one thing we can say is that if we do get a lot of economic weakness or some crazy externality, the Fed is there to drop rates to prop up this economy. So, I think that's one of the biggest things that happened during 2024 was the Fed recognizing that the labor market was easing, so they don't want it to ease too much. And we got this sort of hyper-focused reality from the Fed on the economic data points. So as a result, what we saw in the 10-year Treasury, for example, was a bit of a roller coaster year. We started the year at 4%, and we finished the year at, a little above 4.5%. Now, one thing that people have asked over that is, well, how is it that you drop the Fed cuts interest rates and long-term rates go higher? And part of this is to do with the fact that inflation has remained a little bit higher than expected. And so that gets sort of priced into the term premium in some of these longer dated treasuries. But the other problem this has created for folks is, as you all probably well know, is that mortgage rates have stayed very elevated and have now remained very elevated for about 18 months, going on 2 years. And so that's really hurt the housing market quite a bit. But this also hurts, companies that are trying to refinance. It's just going to cost them more. So we've been watching this very carefully, and we sort of seem to be, I don't know if we're at the peak or not, but we still see very strong disinflationary trends in the economy and are more likely to take the under than the over on this treasury yield. Another way to visualize what happened with interest rates is to look at the yield curve. So if I take a look at this, if you look at this lighter blue, it may be hard to see on your screens, but it sort of started way up high. This is where Fed funds rates were around 5.5 about a year ago. And last year at this time, we were expecting kind of this big cuts down to 4. And then sort of as you go up the curve, essentially, a 10-year that was sitting at around, call it 4.1%, a 30-year, basically sitting out, a little bit north of that. And what you saw basically throughout the year was the Fed cutting the short end, and then the rest of the market pricing in more of a term premium into the longer end. And so you saw this steepening of the curve, which you remember, like when everybody was upset about the inverted curve, which is what we had going into that past year, that was a recessionary sign, frankly, that never materialized this cycle. But now we actually have a steeper yield curve, and that means a whole bunch of things for a bunch of different industries, including financials, which benefit from this type of a shape of a curve. But that was an interesting element that you had to deal with during 2024. And as I said, part of what happened was inflation fell, but it just didn't fall as much as we expected. And so if we look at core CPI, it's basically finished the year at 3.3%. That's still a little elevated on a broad metric versus the Fed funds target of 2%. But if you strip out shelter, which we've been talking ad nauseum for the last 18 months about how that needs to keep coming down, you're at closer to, the actual target of 2%. But, and so there's more work to be done is the answer. And so a lot of what you've heard out of the Fed governors is, talk about, well, we're data dependent, inflation's been a little sticky, not sure if we're going to cut at the next meeting. I think the narrative right now, that's basically the narrative in the market right now, is that there's very little expected in terms of rate cuts. There's really only about 1 rate cut priced in right now. And so it's all going to be data dependent. So, but if we dig a little bit into, as you all know, we like to dig into the numbers, not take them at face value. The key inflation drivers themselves are on the descent, right? So you have shelter CPI, which is, housing, rents, etc. That's been on a decline from its highs. And we think that is definitely going to continue, particularly in environments like Florida, Texas, Nashville, Salt Lake City, Phoenix, Vegas. I mean, you're starting to see, really pretty big material declines in housing prices. So no surprise that we will not be surprised if that continues to drop on a steady basis. Um, and then the other big driver in services inflation was motor vehicle insurance. And as you can see from the chart on the right, that's now going in the right direction, i.e. down. So all in all, I mean, I think the consensus narrative right now is that inflation is sticky and is going to be around for a while. And I'll tell you that I don't really buy it. The main drivers of inflation are still headed lower. And so now, again, we don't know what's going to happen in terms of tariffs. We don't know what other pro-growth or inflationary policies might be put in place by the Trump administration that could prop up inflation. We don't know that, and we'll react accordingly. But I think right now the expectation is that there's more inflation out there than maybe what I believe. All right, so what do we expect in 2025? I've already alluded to a couple things that we're focused on, but where are we? We have right now a very favorable backdrop for higher markets. I'd say we're in a much more positive position today than we were a year ago. The economy is on strong footing. Why? Because the labor market remains solid. Yes, it's easing a little bit here and there, but it's nothing that is concerning at this point. And it's in a very and it remains an important driver for continued solid consumer spending. The services sector remains incredibly strong, actually. In fact, we saw an interesting acceleration in the services PMI that we received just the other day. And what's interesting is if you go into the actual press release and read the quotes that they get from the survey takers, the businesses that are reporting into that survey, there seems to be a little bit of a pull forward in demand on imports and on other input materials and even those inputs that are important for services in advance of the Trump tariffs. So this could be just like a 1 or 2 month little pop, kind of a pull forward, but it does create an interesting scenario where in the short term, might make the economy look a little stronger than it is. And then we'll get a correction, a few months from now when, it becomes patently obvious what happened. But there's an interesting little pull forward that's happening with businesses as they, really frankly don't know what to expect with the Trump tariff policies. So that remains kind of an interesting sideshow to watch here. But even as it is, services have remained in growth territory all throughout last year, and we don't really see a whole lot of reason why that doesn't continue. We also mentioned, in regard to the Trump administration, there's likely to be lower regulations, lower taxes. I'm not sure that the market has fully priced that in, but if you think back to 2017 when the Trump tax cuts went in place, you saw a nice rally in the market when the corporate tax rate was lowered. I think that's one of the things he's trying to get through again. So again, it's another little tailwind behind the market. I mentioned the Fed put protects the downside to a certain extent, but I think that gives people some encouragement and some courage to step into a market knowing that the Fed it will lower interest rates to help prop up markets if it needs to. But I would also say that there are going to be pullbacks. In fact, in just this past month, in December in particular was a big pullback, and some of it's continued into January. And if we just look at my data points from the peak back in December for the S&P, we've traded off 3%. The Nasdaq's traded off 3.3%. The S&P equal weight is traded off 6.2%. So we're getting a pullback right now. And this is, we talked a little bit about this a month ago that I was getting a little nervous about beginning of January, that essentially folks had kind of not sold enough in December, possibly because they didn't want to pay taxes, and that there'd be a bigger kind of pullback in January when people took profits. I think you're seeing that, but you saw a lot of it in December. And so frankly, the pullback that we got in December more broadly actually put me a little bit more optimistic going into this year, obviously. So that said, these pullbacks are inevitable. We got a 5% pullback last year in the S&P, and I think we topped out at 8 or 9. on another occasion, each one was a buying opportunity. And I think that's going to remain the case, all things else being equal. So, as I mentioned, there's lower, expectations for rate cuts this year. That could provide some upside, honestly. There's really only an expectation for about one cut. And so with low expectations, it's entirely likely that interest rates could actually fall, or we could actually get more cuts, maybe two cuts. Again, we're not talking about anything extravagant here, but I think rate volatility is becoming less of an issue for the market. And that allows for a little bit less bond volatility in particular. The one thing, obviously we need to think about here is, do we have a little bit of an irrational exuberance? I think a lot of the sell-off in December has taken some of this off the table, but we kind of entered into December with pretty stretched valuations. Now, valuations can remain stretched for a very long period of time. So that's, you never short a stock or a market based on stretched valuations. But that being said, there's a decent amount of confidence going into this year with consumers, and in particular on their stocks. I mean, you can see on the University of Michigan Consumer Sentiment Index keeps growing. It's up to 74 now, which, by the way, is still way below historical levels that are like in the 90s. Like, if we look back 10, 20 years ago, consumers were way happier than they are today. And I think that's still the weight that consumers feel from the higher elevated prices that we've experienced with all this inflation. But consumer confidence, you can see on the right, is actually also restored somewhat to stocks and what their expectations are for them to go higher next year. So those are good backdrops. But where could the problems come from? So, of course, it's hard in these times to not talk about externalities, whether it's terrorism, war, crazy weather, disease. It's impossible to predict. It would be great if we had a crystal ball that could predict all these things, but we don't. But what we do have in our back pocket is that we're tactical managers, which means that we aren't going to just sit around for 6 months and wait for, things to change. We're going to actually act. And I think that's important. And that's why a lot of people use us, is that we don't sit on our hands. We're actively monitoring the markets, and we'll make changes when they need to be made. But the externalities are just awful difficult to predict. Those are like the black swan things that, the books have been written about. But where could real problems come from that we can actually see? These higher interest rates, could eventually wear down spending and could wear down the hiring needs of businesses. So that's something that we've, talked about in the past, that we're watching. How long does it take to get back to neutral is really the question. And what impact does that have on businesses and their spending needs, and consumers and their spending during that period of time? I mentioned market sentiment. Is it too positive? I mean, no one even mentions the word recession anymore. And not that we see it coming either, but again, a lot of people are sitting on the same side of the boat as far as sentiment is concerned. And, you just have to keep a wary eye to that and be nimble and adjust if that were to change. And then valuations, as I mentioned, are stretched in some places, like in growthy names. We've been talking about whether that could lead to a market broadening over time. We sort of got that in November, was kind of a surge in value names and cyclical names vis-a-vis the growthy technology names. And then it all reversed in December. So, this is one of these things where you don't want to place an entire bet on value versus growth, et cetera, but you need to be sprinkled across them and be barbelled. And that's what we've done in portfolios, because we just, it's just very difficult to call the timing on when the market wakes up and decides it wants to, buy losers or sell winners. But that's something that could potentially create a bit of a problem for some portfolios, given the concentrations I referred to earlier in the Mag 7 and in names like NVIDIA. Now, what some of the mitigants that I'll just put forward is that we have a very unlevered consumer. So if you look at this chart, this is a household debt service payments as a percentage of disposable personal income. And what you can see is that these are not elevated levels that we're at today, at around 11%. They look frankly like history, save for, the weird times around the housing crisis. where we had just enormous amounts of mortgage debt. But basically, there's a lot of equity and a lot of room for consumers to lever up their balance sheets if they run into a little bit of trouble or they lose their job or that sort of thing. And we have yet to even see people start to tap their home equity lines, which is another massive source of, juice for the economy. So we've got that in our back pocket. This is just another way of looking at how unlevered the consumer is. This is household debt to GDP, obviously is really, really low. And, it's important to note too, while we think interest rates are high today relative to, say, the period, they are relative to the period from, say, from 2000 to, 2022. If you look back in time beyond that, interest rates were a lot higher, and and somehow consumers were able to manage through that. So, there's a bit of an offset here about what do interest rates do, but there is still room for consumers to take on leverage. And the same can be said for corporates. Businesses are quite unlevered relative to the past 50 years. And so, this obviously is, again, another potential lifeline to the extent that businesses start to face some difficulties. But this also means that they have a lot of room on their balance sheet to raise debt to grow. So this is kind of an interesting situation that we're at. And we've talked to a lot of businesses out there, and there seems to be a growing level of optimism that a Trump administration will offer them more opportunities to make investments that maybe they were holding off on, or maybe it was, the current regulatory framework was not friendly to. So I think this is going to be potentially another very interesting source of economic growth. And again, I've shown this every single month for the last year. Again, our chief concern is the Fed funds rate, which is this graph is the Fed funds rate minus the core PCE or inflation. It's really tight relative to history. And, for it to be more back to normal, we'd like to see this closer to zero. So in other words, the Fed funds being more in line with the inflation rate. So if we took today's inflation rate at, let's just say, roughly 3%, the Fed funds rate needs to drop another 100 basis points. So that's kind of what we're watching. And in the time that it takes to drop that 100 basis points, do we have, some weakness that starts to seep into the economy? We'll see. But like I said, I think we've got a Fed that is willing to drop those rates on evidence of that weakness. So again, a positive backdrop. And then as we look to kind of how to buy dips and when would we buy dips, the cash on the sidelines just keeps growing. I've shown this chart as well before. We're now up over $7 trillion in money market assets. So you've got, not only the ability to lever up to create cash to buy things, keep spending going, but you also have the existing cash that's just sitting here, whether it's going to go into the market or into spending, I don't know, but it's well above historical levels. And as the Fed funds rate starts to come down, now you're clipping 4% coupons. Maybe in a year, you're clipping 3.5. Eventually, you're going to want to go take some risk. Pardon me. So next big catalyst, we have payrolls, which we are getting tomorrow or on Friday. And then we have corporate earnings season. Pardon me. Corporate earnings season. Many companies will offer 2025 guidance for the very first time. That could be big because we'll get a real sense for what corporations really think is going on. So let's get into portfolio strategy. Now, the first thing I'll say is just because the calendar flips doesn't mean that we're going to see, portfolio strategies change. The market narrative from, the end of last year is going to roll into this year. So nothing really radically changes when the calendar flips. Yes, there's some seasonal differences. You have some, tax loss selling that occurred in December. Maybe people are taking some risk off right now, but ultimately the broad changes in the calendar just don't really change strategies. And as I said, the pullback in December was helpful and allayed some of our January sell-off concerns. We did raise some cash during December and are looking to buy dips in some of our favorite themes that I'll talk about in a second. And there's really no change to these themes, actually, but we are looking they are evolving. So, for example, the artificial intelligence um, theme that we love and we've loved for years, we're sort of looking out further in that chain. So you've seen the hyperscalers move and the GPUs that supply that growth all still happening, but we're in the early innings of, say, the actual application of AI. And so a lot of our focus is on how is it going to be applied to healthcare? How is it going to be applied, elsewhere in the economy or in productivity software for businesses, where we see a lot of this going. So at the end of the day, it's still a great theme, but it's an evolving theme, and that makes it fun for us because there's new stocks to add to the portfolio. We're really happy to stay pretty liquid right now. We've been expecting this pullback that we're getting right now, and so we're happy to see the market come to us. A lot of the new accounts that we're getting right now, we're saying, hey, if you have a little extra cash, we're going to wait a little bit to deploy it because we're going to essentially wait and watch, this market come to us a little bit right now. And then I've said this a year ago, maybe I said it a year before that. Could this finally be the year that bonds work? And we're not betting on it yet. We're still staying kind of closer to the short end of the curve, and we're in some pretty interesting bespoke bond strategies. But by and large, we are still waiting for this curve to steepen a bit more, and until we really, feel like it's a good opportunity to move, well out the curve. So jury's up on that. Global Vigilance, our flagship, the moderate strategy, remains around 60% equities, 30% fixed income, 10% commodities. We'll distribute this presentation later, but you can see all the various different themes that we're in. Happy to go back to this. But we continue to love everything related to AI. We, our thesis on electrification, which is essentially producing more power, is a very powerful theme, and I think a lot of people have heard about it by now. So those continue to be excellent places to invest money. Our tilt strategy, which is our aggressive version of Global Vigilance, is roughly 80% equities, a de minimis amount of fixed income, and has a decent slug of commodities. Some people ask me what's the difference between moderate and tilt, and it's not just the asset allocation. It's oftentimes the names that we put in here are a bit more aggressive in nature, have a higher beta. So I'm going to stop there and take your questions. I know I've said a lot, but I'd love to hear whatever you have to ask.
Great stuff, Jim. I even write down stuff, to ask. I'm like, oh, I need to ask him. And then, 5 minutes later, you've gotten that answered. I gotta scratch that out. But I've been talking to some business owners recently, and they said that sales have been down in their shops. What do we have? Like, did they report like holiday sales or Christmas sales, Thanksgiving sales this year yet? And what
Yeah.
does that look like?
So one great place to find intel on that is MasterCard's Spending Pulse, which is a survey of all the MasterCard, any retailer that uses MasterCard. And by and large, holiday spending was actually up a little bit from last year, up like, 3-ish%, which is pretty solid. Now, depending on where you were in the value chain or where you were across retail, e-commerce remains to be incredibly strong. This, ever since the pandemic, when everybody was stuck at home buying from Amazon, that behavior has essentially continued. And so e-commerce businesses have continued to see very healthy, strong spending as they take share from the offline world. When you get into the offline world, it becomes a little bit different picture. The basically the lower end is really weak. So that's your Dollar Generals of the world. They've started to see, a lot of weakness. But where you haven't seen weakness really yet is in, say, hotels or travel or entertainment. There's still a lot of money being pushed that direction. You've started to see a little bit of, back on the weakness side, you start to see some weakness at lower end restaurant chains. So that's starting to filter into, the consumer's mindset on either whether it's trade down or just saving money or whatnot. Yes, you are definitely hearing that consumers are being more thoughtful about their purchases. They're more, they're looking more for sales. They're trying to be more judicious in their spending. But I would say all in all, things are still relatively strong. Oh, I think you're on mute, Keith.
Oh, I must have
There you go.
accidentally pressed. Sorry about that. So in recent the recent volatility, in that's been going on in the market, how much more of a decline do you think before we would wind up deploying some of the cash that we have in the sidelines?
Yeah, so we're actually deploying some today, even as we speak. We are adding to some of our positions that have gotten, hit disproportionately and trimming some of those that have not. So, to some extent, it's a little bit of a rebalance, you might say, that trimming winners and buying some losers. But it's right now kind of on the margin, but I would expect that that's going to continue over the course of the next couple of weeks.
Gotcha. We got a good question because we don't have it in the portfolio and we rarely talk about it. But what do you think about Bitcoin?
Yeah. Well, so traditionally we have not liked Bitcoin, and traditionally we have not wanted specific Bitcoin exposure. However, we now have a president, and part of the reason, and this is the backstory. Part of the reason was that it's hard to value, and B, there's really no regulatory framework for it. And there is some segment of the political establishment that wanted to potentially regulate it out of existence. And so it's very difficult to invest a client's, irreplaceable wealth with a asset that could go to zero. So that was kind of our historical view. Now it's shifting a little bit in the sense that the Trump administration is obviously now much more positive about Bitcoin. And so I think that lend has forced us to kind of go back and rethink our attitudes about Bitcoin. And right now in our tilt portfolio, we actually own a company that is a Bitcoin miner. Now, that's a little bit different than owning Bitcoin directly, although they do trade similarly because they mine the Bitcoin, then they sell it, and they make a bunch of money from it. The spreads are incredible. But really, what that play is about is the incredibly unique asset that it has, which is a data center. Bitcoin miners are effectively very sophisticated data centers that have all the GPUs you need to do AI, and they have, more importantly, secure access to power. And that is what's causing a lot of AI data center consternation right now. If you were to try to build a data center, probably anywhere in this country, it would take you years to connect to the grid. And so this is a real bottleneck that's being created in AI. And given the amount of money that's being thrown at it, we actually own this Bitcoin miner because we believe that it's entirely likely they'll lease out a bunch of their new capacity that's coming online. And if that were to happen, we think there could be, nothing short of like an explosion in valuation. So we own it, but we own it in sort of a very creative way with a slightly different angle. But that's kind of where we sit today. But we don't at this point just have out and out exposure to Bitcoin in, say, the BlackRock ETF.
Gotcha. Okay. Well, that looks like, oh, hold on. Nope, that's somebody just being a smart aleck. Okay, we have no more questions. Thanks for joining. We look forward to seeing you next month. If you need anything, please feel free to reach out to us at any time. Thanks, Jim.
Great. Thanks, everybody. Thank you, Keith. Bye-bye.